Okay. Well, hello, everybody. Welcome to today's webinar, COVID-19, Emerging Issues Impacting Small Business
Is now joining.
in the Paycheck Protection Program. My name is Michael Sealing, and I'll be your moderator. I'm a partner at AWS Insurance, and I'm excited to be hosting this session today.
Is now joining.
I'd like to apologize for any background noise you may hear because all of us are obviously working from home these days, and you might hear some children or some dogs barking, so please excuse that. I'm pleased to introduce today's speakers, Jason Cerise, a partner at Locklord LLP, CPAs Craig Fallbacher, and Dean Martin with Kushner LeGrays. Jason is going to provide an overview of the PPP, who is eligible, and entity affiliations. Craig and Dean will discuss how to apply for the PPP and loan forgiveness. Craig specializes in the taxation of individuals, partnerships, and small corporations and trusts. Dean handles compliance and value-added consulting services to family and closely helps small and mid-sized businesses. I will be discussing some of the emergency rules issued by the Department of Insurance in Louisiana. Before I hand over the mic to Jason, I have a few housekeeping items to cover about this presentation. First, today's webinar will be available on demand after the live session. It is accessible through the same link you are using now. If you have a question for our speakers, please feel free to send it through the Q&A on the right side of your screen. We will be answering questions at the end of the session. If we do not get your questions during today's webinar, we will be sure to follow up after. So without any further ado, I'd like to kick things off by turning over the mic to Jason Cerise.
Hi, everyone. Michael, are you able to hear me?
Yes, sir.
All right. As Michael mentioned, my name is Jason
Is now
Cerise.
exiting.
I'm a partner in the New Orleans office of Locklord LLP. Locklord's a full-service law firm, and while we've got over 20 offices around the world, my office is here in New Orleans. My practice areas include commercial litigation, bankruptcy, and restructuring. And while many of our firm clients are extremely large corporations, I also work very closely with a number of small and mid-sized family-owned operations on a daily basis. So first of all, I'd like to thank everybody for joining us today. I hope all of you, your families, your employees, and their families are safe, healthy, and doing well under the circumstances. We know these unprecedented times, and these are unprecedented times, and businesses around the country are facing unusual obstacles. As you probably know by now, in an effort to address some of the financial burdens facing the nation's small businesses, the federal government has enacted the CARES Act, which includes what has been known as the Paycheck Protection Program. Now, as the name of this program suggests, the goal is to incentivize employers to maintain their payroll during and through these COVID-19 shutdowns. Now, because we've collectively been receiving a number of questions from our clients, our family, our friends, my co-presenters and I thought that this webinar might provide some helpful information, and hopefully you'll agree at the conclusion. So I want to start with just basically an overview of what the Paycheck Protection Program is, and I'm going to hit the high points, and then we'll dig into some of the detail later on in the presentation.
Unknown participant is now joining.
Michael, could you hit the next slide? So Michael's going to bring up the next slide here in a second on the presentation, but the program generally provides for $349 billion in small business loans, which are calculated based on a formulaic approach of 2.5 times average monthly payroll.
Is now exiting.
These loans are going to be forgiven as long as the proceeds are used for approved purposes. And for amounts that aren't forgiven, the loans will mature in 2 years and accrue interest at 1%. significantly, the program cuts a good deal of red tape that usually accompanies SBA loans. Any SBA lender can make the loans. A lot of typical underwriting requirements are eliminated. Personal guarantees of the business owners aren't required. Collateral is not required. You're not required to demonstrate. You can't obtain credit elsewhere.
Is now exiting.
And your personal net worth is also not disqualified. I mean, this is something, all of those are things that would accompany a typical SBA loan application. And this program has been fast-tracked so that you don't have to worry about all those things. As we mentioned earlier, it's kind of a formulaic approach. It is important that everybody realize that the PPP was fast-tracked. Guidance is still trickling out. There was some guidance issued by the SBA yesterday. And so the details of how the program is going to work are being changed in a few ways. By way of example, some of you may have heard when the program first came out that loan amounts would include payments made to independent contractors. Well, they released an interim final rule last Thursday, and that's no longer the case. And now independent contractors will have to file their own applications. And that's just basically one way in which the program has kind of evolved since it first emerged. The SBA just released some new guidance yesterday. It's expected that they're going to continue to issue additional guidance. I will tell you that
unknown participant is now joining.
That the SBA's website is a very good resource. They release FAQs, or frequently asked questions, with some fairly detailed answers with some regularity, and so I'd encourage you to go visit that. But the upshot is that things are changing, so don't be surprised if there's some bumps in the road as you work through the application process. The SBA, the banks, borrowers, and legal and accounting professionals are to a large degree learning as we go. One thing is for certain, it's okay to get your application early. While you technically have until June 30 to file, it's anticipated that at least the current levels of funding will be exhausted prior to that time. So the first question you're probably asking yourself is my business eligible? And I'll say that the simplest answer to that is if you were in business before February 15, 2020, and you consider yourself a small business, chances are you're going to be eligible under this program. The PPP loans are available to any business concern that meets the SBA's standing definition of a small business concern. But it's also available to some businesses that don't meet that usual test. The act was drafted to cover corporations, sole proprietors, self-employed individuals, independent contractors, and other business concerns. Now, the usual rule that the SBA applies is to decide whether you're a small business. It either applies a employee standard, which goes by the number of employees that you have, or your business's revenue. And whether the number of employees or the revenue is determinative depends on the industry. Specific standards for your industry can be found at www.sba.gov/size if you're interested in that. And they also have a handy tool on the SBA website, which is Measure My Business. And that tool will allow you to determine whether you meet the typical definition of a small business concern. It takes less than 2 minutes to complete. Now, even if you would not ordinarily qualify as a small business concern because you have too many employees or you make too much money, you can still qualify under the CARES Act under what is known as the alternative size standard. And basically, the alternative size standard is if your business's maximum tangible net worth is less than $15 million, and
ceiling
is now joining.
And your average after-tax net income for the 2 previous fiscal years is not more than $5 million, you would qualify under that alternative size standard. And even if you don't meet this additional test, if you have no more than 500 employees, you qualify under the CARES Act. So the rule of thumb to keep in the back of your mind is if you have 500 employees or fewer, which excludes independent contractors, you're probably going to be eligible under this program. So one issue that some businesses face who have a number of affiliates affiliated businesses owned by common ownership. And if you include them in the aggregate, they may not qualify for the Paycheck Protection Program. So if you're interested in looking at those affiliation guidelines, they can be found at the Code of Federal Regulations. The site is 13 CFR 121-301, Section F. But if reading through volumes of federal regulations isn't your thing, Locklord has put together a number of quick studies on the COVID-19 response, and the guidance on affiliates is one of them. And at the end of the slideshow, there will be a link to our resource page, which includes a number of quick studies. The quick studies we put out include a lot of detail on the Paycheck Protection Act, but also a number or a host of COVID-19 issues affecting your business. So generally speaking, if you've got a group of affiliates which is owned, controlled, or managed by the same ownership group or has an identity of interest, that group of affiliates has to collectively qualify for the CARES Act size requirements. That is, unless you're in a specific industry where those affiliation rules are excluded. Now, those industries include certain food service businesses, hotels and lodging, franchisees, and portfolio companies of SBICs, or small business investment companies. Based on the guidance that the SBA just issued on Saturday, that means that any business with an NAIC code of 72 and less than 500 employees qualifies, irrespective of affiliation rules. Any franchisee with an NAIC franchise identifier code qualifies, and any business concern that receives financial assistance from an SBIC qualifies. So if you meet any of those tests, you're in the program. So as you can see, the application or the eligibility for this program is very broad and includes just about every business with fewer than 500 employees. So chances are your business will qualify, though you should take a few minutes to make sure of that. Once you have, you're going to want to know the details on how you apply, and I'm going to turn the mic over to Craig and Dean, who will walk you through that application process.
All righty. Thank you, Jason. This is Craig Fabacher.
Mary Bertucci is now exiting.
Grace. And I'm going to go over some of what the lenders are looking for. And there's so much confusion in this area. So I'm going to follow the Chamber of Commerce came out with a really good guideline that we're going to use for this purpose. If you could switch to that page, Michael. But first of all, I want to start out with, for most small businesses, you're going to qualify. And if it wasn't clear from what Jason told you or from what you've been hearing in the media, I want to make it absolutely clear that this is the opportunity to provide the best free money since the BP oil spill claim. For those that weren't aware with that, our firm tested and filed over 2,000 claims, and we were able to get our clients in excess of $200 million over the Gulf Coast for that. It took about 7 years. Hopefully, this program's not going to take that long. In fact, it should be very quick. But it offers the same, and this one really almost applies to every small business. So if you're a small business and you have employees, you have got to do this. There's some requirements. I'm going to cover
is now
those,
joining,
but they're not that difficult. And obviously, this is certainly needed more now than ever. So if you look at number 2 on the guide on the screen, I'm going to start with to apply. You basically have to have been in business on February 15th of this year. So they're going to ask you to prove that or give them your date of incorporation, the date your business began, and you had to have paid payroll in 19. Or I'm going to talk a little bit about that too. But just like Jason said, 1099s are not going to qualify businesses that have payroll. You're not going to get anything extra for 1099 payments. That was originally in there, but they've excluded that now in some of the regulations they came out with. So the typical things they ask for, like Jason said, you don't have to worry about on this PPP SBA loan. There's no personal guarantee. There's no collateral needed. You don't have to prove that you tried to get financing elsewhere. The one question they're going to ask you that some people have been a little hesitant of, but I think this applies to everybody, is you have to certify that the uncertainty of the current economic conditions makes the loan request necessary to support your ongoing operations. And some businesses will say, well, we're working from home and we're doing pretty good. And yeah, you are, but we don't know how long this is going to last. I mean, right now, the mandate doesn't get released until May 1st. We don't know if it's going to extend beyond that. There is so much uncertainty right now as to what's going on. I think just about everyone could say, that they fall in that case. Maybe if you're like a grocery store, you wouldn't, but for 99% of businesses, I think we're in that position. You have to certify that you're going to use these loans to retain or maintain your payroll and to make mortgage, lease, and utility payments. And then you can't use this loan and then get another SBA loan for the same thing. Now, you can go get a different SBA loan for different expenses, but not for payroll and rent and utilities because they're not going to allow you to duplicate those efforts. And so let me talk a little bit about the documents that the bank will typically request from you. And this is where some of the frustration is coming in. Rather than the SBA rolling out a uniform payroll calculator that would have been welcome, they didn't. So every bank has come up with their own payroll calculator, and they're all different. And some of them, I hate to say, are a little misinformed. They're asking for information they shouldn't be, or they have line items on there for you to complete that shouldn't be. You just have to do your best to work with your lender to get the information to them that's required, at least in their mind, so that they can process the loan to get it to the SBA to get it funded. So what are they looking for? They typically want it. Well, let me backtrack a little bit. You can base this on your 2019 numbers, or you can base it on the last the last fiscal period, 12-month period. So you could use, let's say, March 1st through February 29th of 20. That's up to you. I think the banks like calendar year. So if you can use 2019, it ties in nicely with payroll. They would prefer that. It makes everybody's life easier, unless you've looked at the numbers and you'll do better by using this fiscal period. But typically they want your payroll journals that list out each employee's year-to-date wages and that type of information. They want to see all four of your payroll tax returns you filed with the IRS. That's Form 941. They want to see the year-end W-2s. And they don't have to verify this with the IRS that this is what you really filed. They're just looking for something to corroborate the numbers that you're putting on their payroll calculator form. Most of them are asking for the first 2 months of 2020's payroll journal also. And then they want something showing that the date the business was started, and if you have the articles of incorporation or articles of organization, that's helpful to them also. I'm mostly talking about employer loan applications here. So employers that have employees. Self-employed can file also. They've put a staggered date, like you could start last Friday, April 3rd, with an employer application. The self-employed people can start filing this Friday on April 10th. And all the regulations haven't been issued. It's a little unclear, but it's our belief that the loan and the forgiveness for self-employed people will be based on 2.5 months of their net earnings of their sole proprietorship, plus any payroll that they pay. And then you would multiply that by the same 2.5 to get the number. And I'm going to get into that a little bit in more detail. So the only item that the bank is supposed to consider as far as credit worthiness on the loan is what your credit score is. So you could have some situations where the bank, because not all of it's going to be forgiven, and even though it's guaranteed by the SBA, they're going to look at that, and obviously if you've got questions, you've got to answer it if you were convicted and so forth, and they could deny the loan. But the only item they're really supposed to look at is your credit score. So I'm gonna go to number 3. How much can you borrow? So if you look on the right-hand side, they make it sound very simple. You just take your average monthly payroll, and you multiply it by 2.5%. That's it. It's a little more complicated, obviously. Now that's for most businesses. I'm going to quickly just say that if you were not in business in 19 or for the full year 19, you can use January, February.
Is now joining.
And if you're a seasonal employer, you can use the dates of February 15th of 19 or starting March 1st of 19 until the end of June of 19 as the comparison period for which to determine your loan amount. So if you look at the middle now of section 3, it says, how do I calculate my average payroll cost? And I like the way they put it. It's the sum of included payroll costs minus the sum of excluded payroll costs to get that number. So let's go into included payroll costs. Includes wages, salary, commissions. It includes tips, vacation, if you're paying somebody for vacation or sick leave, if you're paying somebody that's been dismissed or separated. It also includes their group health insurance benefits payments and any retirement payments. And then lastly, the employer can also
is
add
now exiting
Louisiana unemployment tax to that number. Some banks originally included in their calculator 1099 payments to independent contractors, but those no longer apply. So let me go to the excluded payroll costs now. This is where it gets a little tricky. So first of all, they're not going to give you a loan or forgive anything where you pay somebody, an employee, more than $100,000. So you would have to back out any compensation over $100,000. Now that's gross wages. Now what we learned today from regulations last night is that to that 100,000 limit or cap on a highly paid individual, you can add health insurance and retirement payments that you made in 19 for those persons. So again, you take the average monthly amount for that. The second item was really a mess. A lot of banks weren't sure how to do this, and everybody was doing it different. We're going to make that easy for you. It says to exclude payroll taxes and income taxes. So originally it was thought that you had to subtract out each employee's FICA and federal income tax withholding, in which case we're like, geez, that's going to knock the claims down by 30%. Regulations last night, thank goodness, came out and said that you do not reduce gross wages for federal withholding and FICA. So good news is there, you can get a bigger loan and get a bigger forgiveness at the end. The next item, if you have any employees that live outside of the United States, you got to exclude them. And the next item, I would not worry about for now. For purposes of getting the max loan, you do not have to reduce any wages for which a credit was obtained under the FCRA Act that came out last month. That might play into the loan forgiveness. But on the loan, it's basically going to be that payroll for each person, and then you'll subtract out the amounts under $100,000 for the highly paid, and then you're going to add the health insurance, add the retirement benefits. For 19,
is now
divide
joining.
that by 12, multiply it by 2.5, and that's your loan amount. When you fill out the payroll calculator that the banks are providing to you that they want in order to give you the loan, you should have a number that agrees with the number they come up with. And if you're good with that, then you're good to go. The main thing that I want to say here is that you only get one bite at the apple here. They will not give you a second PPP loan. So if what the bank is approved and is saying your max loan doesn't agree with what you think, you need to talk to them about it. You guys need to come to the agreement on that so that you're getting the full amount up front. I'm sure there's going to be more clarification and more regulations that come out that are going to explain this further, but that's where we stand right now. So next, and probably the more important part, is that you want to get as much of these loans forgiven. And I'm going to turn that over to Dean Martin, my partner, and he's going to explain that piece for you.
Thanks, Craig. So once you receive the loan, the next step that we're going to go through is how much of this loan could be forgiven. And ideally, everyone would like for 100% of that loan to be forgiven, but we'll go through the mechanics on how the calculation works to see where you would stand on the forgiveness piece. And then I'll also cover some tips that you can utilize to first help you navigate the forgiveness process as easy as possible, and then also hopefully to maximize that forgiveness amount. So first of all, on the mechanics of the forgiveness, we have the SBA slide about the forgiveness, which is a great one-pager. It lists all the details that we have right now on just how this forgiveness is going to work. The SBA will issue regulations on the forgiveness that are going to go into even greater detail and probably answer a lot of the more detailed questions we've been receiving about the forgiveness. Those regulations and the CARE Act were mandated to come out no later than 30 days from passage of the bill. So we expect that those regulations will be out sometime between now and 3 weeks from now. So once you receive the loan, as Craig outlined, you're going to get a loan equal to about 11 weeks worth of your payroll costs if we look at the 2.5-week average. The first step on the forgiveness, starting from the origination date of your loan, is your forgiveness period, and that lasts 8 weeks after the origination date of your loan. So you got a loan for 11 weeks of payroll roughly. Your payroll costs over the next 8 weeks that you incur and pay are eligible to be forgiven. And the definition of those payroll costs are going to be the exact same as what Craig walked through as far as payroll on the loan calculation. With the one difference is that you may have some paid leave paid in accordance to the Families First Coronavirus Act. If you do, you've already gotten a credit for that leave, so that part is not eligible to be forgiven. Other than that, the payroll over that 8-week period, exactly same calculation as the loan application itself, except that payroll is what's paid over 8 weeks. Your loan covered about 10 to 11 weeks of payroll. Now, one thing that you also get to add on the forgiveness piece is some other costs that you're going to incur during that 8-week period. And that would be your rent, the interest portion of a mortgage obligation. And what the mortgage obligation is defined as is a mortgage secured by the business's real estate or personal property, which would be equipment or furniture or things like that. Also, you can add your utility payments incurred over that 8-week period, which should be electric, gas, water, telephone, internet, and also transportation.
Is now exiting.
But we don't have a clear definition of what transportation costs that are forgivable are going to be. I would expect that to be more clearly defined in the regulations. So those are the two pieces of the forgiveness costs, the payroll and then the other costs. And regulations from the SBA have since stipulated that your other costs, your rent, interest, utilities, forgiven cannot exceed 25% of the total forgiveness amount. So you may have to limit those other costs if they are in excess of 25% of total. But once you have all those added up over that 8-week period, the next thing you're going to do is apply the 2 potential limiting factors. And the first one is probably the larger for most applicants, or has the potential to be the larger for most applicants. And that would be limiting based off of your reduction, if you had a reduction in full-time equivalent employees over the 8-week period after your origination date of the loan. So you would figure out your average full-time equivalent employees during that 8-week period, and you would compare that to either whichever of these 2 options works best for you, and you're going to want the lower number, the average full-time equivalents for the first 2 months of the year, January, February of 2020, or your full-time equivalent average last year from February 15th to June 30th. So if you were to reduce your full-time equivalents over the covered 8-week period by 10% compared to the lowest base of those 2 options, then your total forgiveness would also be reduced by 10%. If you're a seasonal employer, then you're required to use the prior year.
Paul here in Dynamic Imaging Service.
You cannot use the first
Is
2
now
months
exiting.
of 2020 if you're a seasonal employer. Now, as far as what the definition of a full-time equivalent is, that is another thing we expect to be explained more clearly in the regulations, as far as, you know, how much is a part-timer count and things like that. So that's the first limiting test. The second limiting test that you have to apply would apply if you were to reduce compensation of employees by greater than 25% over that 8-week period after you receive the loan proceeds. And unlike the first test, this one is applied on an individual employee by employee basis. So you would look at each individual employee, and you can throw out, and you will throw out any employee that has wages in excess of $100,000 a year prorated in any period in 2019. So your highly compensated employees, you would throw out and not even consider them when applying this test. Everyone else, you would have to look at them individually. So over the 8-week period, you can reduce compensation if you choose up to 25% for an individual employee and would not be penalized on forgiveness. Any reduction that they receive in excess of that 25% would also reduce your forgiveness.
Is now joining.
And your forgiveness would be reduced dollar for dollar for a reduction in excess of 25% on an individual employee. So those are the 3 main steps that you go through in calculating your forgiveness. Add up total payroll and other costs over the 8-week period. Do not have other costs in excess of 25% of total. Then you apply the limit or reduction if you had a reduction in full-time equivalent employees over that 8-week period. And then finally, reduce the total forgiveness amount dollar for dollar for any reduction to an employee in excess of 25%. Once you have that calculated, the next step is to go ahead and submit to your lender the calculation as well as documentation. The documentation, I expect the regulations to go into further detail on that. They're probably going to ask for things like bank statements, canceled checks, and things like that. Once your lender has your documentation, the regulations say that they can rely on that documentation. They don't need to audit it or otherwise verify accuracy, but you do need to submit it. Once they have done their review, then they would calculate or agree with your calculation, hopefully, of the forgiveness amount. They would submit that to the SBA, and the SBA would then pay your bank the forgiveness portion calculated plus any accrued interest on that forgiven amount. So not only are you going to get the principal forgiven, but you would also get the interest on that principal forgiven as well. And then finally, this is a great news for applicants, great news for taxpayers. The bill stipulates that the forgiveness of indebtedness on a PPP loan is not to be considered taxable income. And that's a great benefit. Usually, forgiveness of indebtedness is always taxable on it to the taxpayer unless they're insolvent. But in this case, you don't have to worry about paying taxes on any principal of a PPP loan that gets forgiven. So that's the general walkthrough of the mechanics on how the calculation is going to work. And as far as tips go, I really have just two main tips to recommend you implement to make this process easier for you and then hopefully to maximize the total amount of loan forgiveness that you receive. The first one is a little bit of housekeeping, accounting information, and that would be whenever you do get the loan, I would recommend that you open up a separate bank account, put the loan proceeds in that separate bank account. And as you pay expenses over that 8-week period that you receive forgiveness on, you want to pay from that bank account only the expenses that are eligible for the loan. So pay your payroll from that bank account, pay your rent, pay your utilities, pay your mortgage payments if you have any. So to the extent that you do a good job of separating those loan proceeds and isolating the forgivable expenditures to only come from that bank account, it's going to make the accounting for it on the back end a lot easier to do, rather than having to go through all of your expenses or all of your bank transactions during that 2-month period. And then second tip would be you really want to look at the forgiveness going forward. You want a forward-looking approach on the forgiveness. So I would recommend that you calculate the anticipated forgiveness on the loan when you receive the proceeds. Don't wait until the 8-week period is over, because once that 8-week period is over, you can't really do much about the part that's going to be forgiven. So to the extent that you're looking forward and calculating the anticipated forgiveness, know your full-time equivalents for the 2 possible base periods of January through February of 2020 or February 15th through June 30th of 2019. That will give you a much better expectation of the amount that will be forgiven. Also, maybe there's things that you can do during that 8-week period to increase the amount of forgiveness eligible, as far as your employee count, the compensation you pay to your employees, rent, utility payments, and things like that. So you want to go through that forgiveness on the front end, and then hopefully that will lead to results after the 8-week period is over that is not unexpected and leads to the maximum amount of forgiveness that you are eligible for. So that's a quick overview on the forgiveness. Like I said, regulations to come on that. Regulations will go into much greater detail and answer a lot of the specific questions that some people are asking on the forgiveness. And I'll hand it over to Jason again, who will go over some legal aspects about the loan forgiveness.
Yeah, thank you, Dean. And this is just a few very quick points so people can understand what happens with these loan balances. For those of you who care what happens to your lender, and we may have some lenders on the line today, I know I forwarded the call to a few, what happens to the loan amounts that are forgiven? Well, within 30 days of a determination that a loan that qualifies for forgiveness, the SBA writes that lender a check for the forgiven loan amount, and that's applied as against the borrower's loan balance as a credit. And as mentioned and as contemplated, there may be certain portions of your loan balance that will not qualify as forgivable amounts. So the question a lot of borrowers will be focused on is what happens to those amounts? Well, as I mentioned earlier during the presentation, they're going to be subject to a 1% interest rate, which is very low, obviously, and they will mature in 2 years. It's important for people to realize that while there are no personal guarantees here, and while there is no collateral for the loan, it is a debt, and if it's not forgiven, it needs to be paid back. And if it's not paid back, technically your lender could go get a judgment, and then execute on the business's property. Now, there are some practical limitations that may, result in a lender not taking that approach. And, one of those is even the unforgiven loan amounts, even those are also backed by the SBA. So the most likely scenario is the lender would go to the SBA and say, I had an unforgiven loan amount, it hasn't been paid, please pay me the balance. And then the SBA will pay the balance, and the SBA may pursue the business, it may not. And time will tell how that plays out. Now, one of the most important benefits of this program is the non-recourse nature of the loans. So I ask you, and I can't stress it enough, don't jeopardize that by falsifying an application or using proceeds for unauthorized purposes. That's about the only way that you could step in it and potentially subject yourself to personal liability and beyond that criminal problem. So with the very low documentation thresholds in these loans and the reduced underwriting and the cutting of the red tape, there will be a lot of temptation, and I have no doubt a lot of abuse in this program. And I'm just ask those of you listening to us not to be participants in that. Certainly borrow what you can borrow within the rules and use it for what you need to use it for to help your business, but don't jeopardize the benefits of the program. Now, this is about the cheapest debt you'll be able to find, even if it's an unforgiven piece, but it is a debt, and you just need to be mindful of that going forward. And that's really all I wanted to talk about there. So with that, unless Dean and Craig had anything further, I know that Michael wanted to talk to you about some emergency insurance rules.
Thanks, Jason. Yes, I do. Thanks, Craig and Dean as well. Great information. Appreciate all the time and effort you guys put in to get this out to everybody. I want to be brief and just go over a few of the items Jim Donellan has issued from the Louisiana Department of Insurance. The first one's really kind of easy. It's Rule 36, and that's basically allowing all health insurance companies to waive any cost sharing items for coronavirus or COVID-19 testing or hospitalization. So that's good news for all health insurance providers. Another one is Rule 39, and that is more specific to property and casualty lines of coverage, which would be something similar to work comp, general liability. Basically, any policy that you have that is an auditable policy, you can request from your insurance provider to have a midterm audit, and you can have your premiums reduced based on your sales and or payrolls. You should definitely reach out to your current agent to work with your insurance provider to get a midterm audit. And then Rule 40 is also issued by the Department of Insurance. And Rule 40 is a moratorium on cancellations and non-renewals and terminations of insurance policies, and that's both across the board from health insurance providers as well as property and casualty insurance providers. It also controls some of the finance companies for premium financed deals, and as well as E&S markets, which is excess and surplus markets. So these rules have really been put in place to protect businesses who are having trouble with cash flows and other situations, so that you don't lose insurance coverage during these times. And that would be it for the rules. There are other rules, but they don't really say as much, and they're not as pertinent to what most people are going to be interested in looking at. So that really covers the emergency rules very briefly from the Department of Insurance in Louisiana. And I do see that we have a bunch of questions, so I'm sure that Jason, Craig, and or Dean would like to answer some questions. So if you all have been muted, y'all can unmute and I can ask you all some of these questions. Do y'all have a couple minutes to answer a question?
Absolutely.
Of course.
All right. So Craig, this one, I guess this is a Craig or Dean. What if the firm applying for the PPP loan is a partnership and the owner's partners receive a draw and a K-1 rather than a salary? Who or how do you report their compensation?
Hey, Jason, this is Craig. I'll answer that one, Dean. And unfortunately, I am going to have to qualify that with, we still are waiting on regulations on that. Like we mentioned before, we got some regulations late Thursday and some last night, but they still have not addressed that. So we're unfortunately, we're relying on what the banks will allow right now, which I don't know that we always agree with, but it's our belief that if you're a partnership and therefore you have several owners who don't get wages, they don't get W-2s, they get paid through a K-1, a draw, how are they to include those amounts on the loan application? And it's our belief that they're very similar to employees and they should be included on the firm's loan application. And we've been instructing clients to do it that way currently until we get guidance on that. But I will admit that there are some banks that have rejected loan applications from firms saying, no, we're not going to allow that. Those individuals have to file their own individual loan applications, which is certainly going to make more paperwork, make it more complicated. So we're trying to get to the bottom of that. We just don't have a good answer right now. I would say if you're in that position, talk to your banker, see if they will allow you to do it all in one, make your life easier. And if they won't, file it right now with what you can get, and the individuals may have to go and get it separately unless you want to wait.
Okay. Well, this question kind of correlates to that. This is, are 501c3 nonprofit organizations businesses eligible?
I can answer that, and the answer is yes. The 501c3 organizations are an eligible entity type. Other types of nonprofits like 501c4s are not.
Okay. All right. Well, that looks like some of the other questions really don't pertain to anything we discussed. So I think with that, unless y'all have anything to add, I want to say thank you for our attendees for attending. If y'all have any questions, you can always click the link that was sent to you originally, and this will be available on a recorded basis. And Jason, Craig, and Dean, do y'all have anything to add?
I don't. Just thank everybody for participating and visiting
Is now
with us today.
exiting.
We hope that we can help you through any questions that may arise.
Yeah, I don't either. I just want to tell everybody, stay healthy, stay well. We'll get through this, guys.
Okay. Well, thanks a lot, and everybody stay safe and healthy.